Good morning, good afternoon, good evening, depending on when you are in fact watching this presentation. Our next topic is capital budgeting. Well, basically we can translate capital budgeting into Lithuanian as investicinių projektų vertinimas. We can translate capital budgeting into Russian as анализ различных инвестиционных проектов. So today we are going to take a look at the capital budgeting process. We'll have to define it first. When we are going to take a look at the different methods which are frequently used in the capital budgeting process. So let's get started. So let's take a look at the process and the definition first. First of all, how do we define capital budgeting? Now, the capital budgeting is the process of evaluating and selecting long-term investments that are consistent with the firm's goal of maximizing owner wealth. What does it actually mean? Well, in fact, we are engaging in some kind of a process where we are going to select some kind of projects, some kind of investments. And of course, we are not going to select them on a random basis. We will need to conduct a very thorough analysis before that. So that's a process of evaluating and of course then selecting those long-term projects, those long-term investments. Now in here we also need to define two different types of cash flows which we will frequently see in capital budgeting process. First one is a capital expenditure, and that's the outlay of funds by the company which is expected to produce some kind of benefits in the future. Basically, a capital expenditure is that initial amount of money that you need to spend in the beginning of your project to start that project running. So for example, if you're building a factory, of course you will incur some kind of construction costs. That would be an example of a capital expenditure. Now, an operating expenditure is an outlay of funds by the company which will result in the benefits received within that first year. In other words, once you will start working on that project of your factory, you will have your own capital expenditure, but at the end of each and every year you will be once again doing your accounting, financial statements, and you will see that you will also need some money in order to operate within that factory. So for example, you will have to pay your employees who work in that factory, you'll have to pay for the suppliers and so on and so forth. Now this would be the example of the operating expenditures. Those would be the recurring, day-to-day usual expenditures which are common in your business, in the nature of your business. So let's take a look at the process of the capital budgeting. Of course, the very first step is a proposal generation. Basically, we need to generate some kind of decent proposals for that investment project. Where could they come from? Well, usually they are coming from people who actually work for that company, but that's not always the case. So, for example, your customer might actually give you some kind of bright idea, and that idea would turn out to be a good proposal. Sometimes various stakeholders might also come up with some kind of proposals. So you should be on the lookout, not necessarily getting them from your own company. Second stage is the review and analysis. Well, financial managers perform formal review and analysis to assess the merits of the investment proposals. Basically, a financial manager will collect all these proposals, will collect all this information, will make the calculations, some kind of budgets, some kind of estimates, how much is it gonna cost, what's gonna be our capital expenditures, what's gonna be our operating expenditures, and then the financial manager is gonna make the calculation on when the company will be able to get the money back. So that would be that review and the analysis process. Usually quite a lot of financial analysis is done, lots of financial measures are calculated, and later we are in fact going to take a look at some of them. Third one is the decision making. Okay, now we have collected all these proposals, we have analyzed them, reviewed them, now it's time to make the decision. And of course those decisions are frequently done by the financial managers, but usually in the consultation with the top managers of the company as well. And of course most of the companies would have some kind of limited funds, so that decision making also tends to be quite a hectic process. Second stage is the implementation. Now, once the approval is granted, expenditures are made, the projects are implemented. If you have a very large project, in that case, the expenditures might even occur in phases. So, for example, if you have a large factory to build, you might have a first phase in which you will, let's say, build part of a factory, and then you are going to complete it and do the like the second building in, let's say, 2 years time or 3 years time, and so on and so forth. Now, a lot of accounting and finance textbooks usually stop at the implementation stage. However, there is also the fifth stage, and that is the follow-up audit stage. Basically, it's not enough just to make the decision and to implement. It's always a good idea to see how well are we doing. So we always need to monitor the actual costs, how much did we spend, what other benefits did we in fact generate enough revenue, did we generate enough benefits to our expectations. And of course, if our actions are not so well, and we can see that we are not doing as good as we were expecting, in that case, maybe you would need to take some kind of action. And maybe you have to change your cost structure, maybe you have to adjust your analysis, maybe you just need to spend less, or in fact even spend more. But of course, some kind of adjustment would have to be made. Basically, we can divide all the projects into two categories as well. We can have independent projects, and those are the ones that have cash flows which are unrelated to one another. In that case, if you will accept one project, you can take the second project and the third project, but one project does not eliminate the other from the consideration. Or you might have a situation in which you have a mutually exclusive project, and in that case, one will eliminate the further consideration for all these other projects. So you have to choose either that one or another one, but you can't take two simultaneously. In some cases, you might have unlimited funds, and that would basically mean you can spend as much money as you have. But in most cases, the company will have to impose some kind of capital rationing. And that's the situation in which the firm has a fixed amount of money for these capital expenditures. And of course, since you're all studying economics, you know that resources are limited. So that would be the typical situation that most of the companies would in fact have. A little bit more on terminology. An accept-reject approach is the evaluation of the capital expenditure proposals when you try to determine whether they meet the firm's minimum acceptance criteria. So in other words, you might have, let's say, 15 different projects, and you basically evaluate all of them on a basis whether this one should be accepted or it should be rejected. And basically you can have that binary outcome, either yes or no. Now, in some cases, the companies might choose to do the ranking approach, and in that case, you will rank all these capital projects from most attractive to the least attractive based on some kind of measure. And today we are going to take a look at multiple measures. That could be, for example, rate of return, that could be some kind of profit, so on and so forth. There are quite a lot of these different measures out there. Okay, now we are diving deep into what we are supposed to be doing in that particular topic, and that is we need to take a look at different capital budgeting methods. What's important? Well, first of all, we really need to know how to do the calculations, how to do them properly, know the decision criteria, so when we undertake a particular project or do not undertake a particular project, we can talk on the usefulness of each and every method. We can talk about the disadvantages of a particular method, so key good points and the problems which are associated. And in here we are going to take a look at the 4 key methods. We are going to take a look at the payback, discounted payback, NPV, net present value, and the internal rate of return. Before we actually start talking about all these different methods, it would be a good idea to learn a little bit more of the terminology. Well, in fact, not really the terminology, but some of the key points on how do we select and allocate the inputs into all these different models. First of all, we need to keep in mind the incremental costs and benefits. What does the word incremental mean? Well, incremental means marginal. It's the same thing. So basically the cost of benefit which will result from adding that additional extra unit, from undertaking that particular project. So for example, if you are, let's say, a company, you're expanding your factory and you are buying some kind of equipment, well, the incremental cost will be the cost of that particular equipment. So all these extra additional costs which you are going to have. The second one is the notion of the sunk costs. And remember, the sunk costs are the costs which have already incurred, which are already gone. And the idea is that we do not include sunk costs in our calculations. For example, imagine a situation you are proposing some kind of new business venture and you have hired a consultant and you have paid that consultant, let's say, 100,000 liters. Now, that's a sunk cost. The fact that you have already paid is not going to have any kind of impact on whether you are going to undertake that project or not. That's a sunk cost, it's gone, and it should be forgotten, should not be included in our calculations. Third one, the notion of the cannibalization of sales. What does it mean? Where does it come from? Now, imagine a situation LCC would want to, our university would want to introduce a new program. And in that case, of course, there will be some people who would not get into business administration, would not get into psychology, would not get into theology or English, but they would in fact decide to study in that new program. And that would be the example of a cannibalization of sales. Basically, some sales will be foregone because people would in fact switch from one to another. Now, I understand that this is quite difficult to estimate those effects of that cannibalization, but if you can do that, that's definitely a very, very good thing to do. At least have in mind that there will be some kind of minimal effect. A classical example is Coca-Cola Company. In the 70s, when they have decided to introduce the Diet Coke, they thought that this one's gonna be the new product, very exciting product, and they really spent lots of money on that product introduction. But what has in fact happened is that quite a lot of people have simply switched from the regular Coke to the Diet Coke, so the extra incremental additional effect of adding that additional product was in fact pretty minimal. Opportunity costs. The idea is if you can calculate an opportunity cost, even if you can't calculate, you still need to keep in mind that, of course, you have chosen that particular project, you have decided to go for that course of action, and you are losing on your best alternative. So it's a good idea to estimate how much you're in fact losing and try to incorporate that into your decision making. Now, all the calculations should always be done on the after-tax basis. Why? Because cash outflow is in fact increased by the taxes. So of course tax is a very real cash outflow and it has to be taken into consideration. Third point, don't forget working capital requirements. Each and every time you're introducing the new project, not only you will spend some money on just that project alone, but most likely you will need more of a working capital. Now, do you all remember what is a working capital? Remember, that's the difference between the current assets and the current liabilities. Or in other words, the extra capital which is needed for the usual day-to-day operations of a business. For example, to pay your suppliers, to pay bills on time, and so on and so forth. Fourth point, do not include interest expense in your calculations. Now, that might sound a little bit counterintuitive, right? Like, why do we do that? That's an interest expense, of course, that should be included. That's a real cash outflow. Well, in fact, we shouldn't include those, and the reason is quite simple. Later, we are going to discount our cash flows at the cost of capital, And the cost of capital already incorporates that notion of the interest expense. So in that case, if we would include the interest expense once again, we would be double counting. And of course, we don't want to do that. But the key and the most important point of all the capital budgeting is always use the cash flows, but not the accounting incomes. Now, that's the point why we spend so much time talking about cash flows and how to calculate the cash flows, is that in fact we are going to use the cash flows from operations, but not the accounting income. Why not the accounting income? Once again, the idea is quite simple. Companies can be profitable, but they might struggle with cash. And that profitability is nothing of importance for the financial manager. Yes, you might have a super duper project. It might be profitable in the first year, second year, in the third year, but you might only see the cash flow in the 6th, 7th, 8th, and the 9th year. And of course, it's not going to be that attractive because we need to keep in mind the liquidity issue. And now I would like to introduce you to projects that we will be working upon as an illustration for our all different methods. So in here we have a situation where we have the ABC company and they have a choice of two projects. They can either take a project A or project B. For a moment, let's pretend that those projects are mutually exclusive. So they have to choose either the first one or the second one. In here, the information is already given about all the cash flows. So somebody nicely pre-calculated everything for us, taken care of the opportunity costs and sunk costs, and included only the incremental costs and changes in the net working capital. So all that is nicely done for us. These two projects have the same initial cash outlay. So you need $2,800 in order to run the project A in the very beginning, and you also need $2,800 for project B. So both of these projects would need the startup financing of $2,800. You can also see two tables, first one for the first project and the second one for the second project, which list all these different cash flows. First one lists the net cash flows NCF for project A, and that simply means that in the beginning, at the time 0, we need 2,800 in order to start that project. We need 1,400 in the first year as our, sorry, not that we need, but we get, so it's plus sign, we get 1,400 back as the recoup of the investment of that project. In the second year we get 1,000, in the third year we get 800, and in the fourth year we get 400. Now, same for project B, we need the initial cash outlay of minus 2,800. In the first year we get 400, in the second year we get 800, in the third year we get 1,200, and in the fourth year we get 1,600. Don't worry about the cumulative net cash flows yet. Those will be necessary once we will move on and talk about all these different methods. So now once we have all these cash flows organized, let's in fact take a look at these different methods which we can use for the analysis. The first method is called the payback method. Investicijų atsipirkimo laikotarpis, точка окупаемости. And the payback method is the amount of time which is needed for the company to get the initial investment in a project, as calculated with the help of the cash flows, obviously. So in here we are using a payback method, by the way, which is the most simplistic method of all of them. And we simply want to find a time frame, so the amount of time which is needed to get the initial capital back. So if we have invested 2,800 in that particular project, we want to find out how long does it take us to get that money back. Simple as that. The decision criteria is quite simple as well. We calculate the length of the maximum acceptable payback period we determine that by management. So we sit down with CFO of the company and the CEO and the top managers, and we say, for this particular type of projects that we are analyzing, we need the cutoff period of maximum accessible payback period of, let's say, 4 years, 5 years, so on and so forth. Now, if this one is less than the maximum acceptable payback period, we accept the project. So we like it, we take it. If this one is bigger, greater than the maximum acceptable payback period, we do not take the project, so we reject the project. Now let's see how all that works in practice. Well, once again, in here we have our two projects, project A and project B. But notice in here we start calculating the cumulative net cash flow, which is the second row in our table. Basically, what I'm doing in here is that I'm adding up all these cash flows together. So I start with minus 2,800. I add up the positive 1,400 and calculate the cumulative net cash flow. In here, this one is still negative and still equal to minus 1,400. Now I add the second cash flow, which is 1,000. So minus 1,400 plus 1,000. That would give me minus 400. Still a negative one, so I have to add another cash flow. And I'm gonna add the third one, and of course that would be 800. So I take the minus 400, I add the positive cash flow of 800, and I get the positive 400. So apparently my payback period is gonna happen somewhere in 2 years and something. 2 full years and some kind of partial third year. Now I'm doing exactly the same with project B. I start with the minus 2,800, which is my initial investment into that project. My first cash inflow is plus 400. So I take the minus 2,800, add the 400, and I got still that negative number of minus 2,400. I add up the second year's cash flow, which is 800, and I still get the minus 1,600. Now I'm still in negative territory, and once again I'm adding up the next year's cash flow, which is 1,200, and minus 1,600 plus 1,200, I get the negative 400. And since I'm still in negative territory, I have to do it once again, and I'm adding up that next for 1,600. And now I finally get positive number, I get 1,200, so my payback is gonna be 3 years plus something. Now so far we have said plus something, but in fact we can calculate that in a precise way. We have a following formula, and the payback is equal to the years before the full recovery. So in here we are using the full number plus the unrecovered cost divided by the yearly cash flow. Now let's take a look for the calculations for project A. 2 full years have passed, so I'm using 2 as my years before the full recovery. Plus there is unrecovered cost, which is still 400. So that's how much I still need to recover. And then I divided by the yearly cash flow, and this one was equal to 800. So my unrecovered cost is 400, my next year's cash flow is 800, and I get 2.50 years. So 2.5 years. Now I do the same for project B. We have already calculated that there are 3 years before full recovery. There is still 400 left, and that fourth period cash flow is 1,600. So I take 3 plus 400 divided by 1,600, I get 3.25 years. So that's a precise formula for the calculation. By the way, it's also a good idea to know that formula, because in finance you can't just say, oh, it's 2 plus something years, or it's 3 plus something years. No, in finance you want to be as precise as possible. So 2.5, 3.25. Once again, you take the years before full recovery, so you take the full years which you have already pre-calculated, plus the cost which is left divided by the next year's cash flow. And you get the payback expressed in a precise way. Let's take a look at the advantages and the disadvantages of a payback method. In fact, there are quite a few of the good things and there are quite a few of the bad things. First of all, the key advantage of a payback method is that it is extremely easy to calculate. It is extremely easy to understand as well. What you are doing, you are just adding one number after another, after another, after another, and everybody can do that. You don't need a finance degree in order to do that. It's also quite easy to understand because you are looking for some kind of a measure which is expressed in years, which is once again quite intuitive. Second advantage is that this particular method deals with risk. The project with a shorter payback period will have less risk than a project with the longest payback period. So of course, some things go bad from time to time. You might budget, let's say, spend 1 million on your factory. In reality, you might want to spend much more because you have not anticipated something. So each and every project carries some kind of level of risk. Now, the good point about the payback method is that it incorporates that notion of risk. Because by nature, by the definition, short-term projects will have less risk as opposed to the long-term projects. Once again, quite logical. Third one, it's biased towards liquidity. Once again, remember what is liquidity? Yes, the ability to convert something into cash. So liquidity, liquidomas, liquidность, very important point for the companies. They want to be as liquid as possible because they need money to pay the employees, they need to pay money to pay for utilities, advertising, taxes, so on and so forth. So companies frequently do think about liquidity and they try to maximize that liquidity as much as possible. This particular method is biased towards liquidity, so you will accept the most liquid projects. And this is very good for the small companies and for the startup businesses. Basically, if I'm consulting or analyzing some kind of startup business, I will start my analysis with that more simplistic but still quite useful payback method. So it's good for small companies that have liquidity issues and for whom it is quite expensive to borrow, and for the startup companies which always have some kind of liquidity issues. Okay, those are the advantages. Let's take a look at the disadvantages. It ignores the time value of money. Now, in the previous example, the cash flow in period 1 and the cash flow in period 4, they had the same weighting. And of course, you know that it's a huge mistake to ignore the time value of money, because $1 today is not the same as a $1 in 5 years' time, which is not the same as a $1 in, let's say, 15 years' time. So that's a huge disadvantage. And of course, that's probably one of the worst things about that particular payback method. Second point, it requires an arbitrary cutoff period. For example, if we are analyzing our project A and project B, and we have a cutoff period of, let's say, 3 years, that's quite subjective. Why 3 years? Why not 5 years? Why not 6 years? How do you base those decisions? What do you base them upon? And so on and so forth. So that's a disadvantage. It ignores any cash flows beyond the cutoff date, which is in fact quite problematic as well, because, for example, remember our project A was much better than the project B. We had 2.5 versus 3.25. But what if in the period 5 and 6 in the project B we have huge cash inflow of, let's say, $15,000? Now, in that case, we would ignore the project B, but it could be much more profitable than the project A. And that's another key disadvantage of a payback method. And of course, this one will be biased against long-term projects. Basically, if you will use the payback method only, without consideration of other methods, you will never spend money on such things as research and development, because of course it's gonna be not profitable, but maybe you will have a huge profit in the long term, in the long run. But you will base your decisions and you will base them against those long-term projects.